Most traders wake up early, chase charts, and still lose money. Yet someone quietly investing in a simple ETF, like the S&P 500, has outperformed 90% of professionals for decades. Since 1990, that lazy investor turned $10,000 into $150,000. So, how did doing less become the smartest move in finance? The myth of smart money. Every bull market creates its heroes, the traders who look like geniuses when everything goes up. But history humbles them all. Between 2000 and 2020, over 92% of active fund managers underperformed the S&P 500. That means the so-called smart money failed to beat a list of companies anyone could buy through a single ETF. So how did the lazy investor end up smarter than Wall Street? The truth hides in plain sight. Most traders lose to costs, emotions, and time. A typical active fund charges about 1% per year, while an S&P 500 ETF like Vanguard's costs 0.03%. That small gap compounds into a fortune over decades. A $100,000 investment growing at 8% turns into $1 million in 30 years. Knock off that 1% fee, and you end up with $760,000, a quarter gone to management fees. Then comes timing. Even professionals chase trends. During the 2008 crash, panic selling wiped trillions from portfolios. Yet those who simply held index funds doubled their money by 2014. The market recovered. Human emotion did not. In 1976, John Bogle launched the first index fund and was mocked for promoting mediocrity. Decades later, his idea became a $10 trillion industry. Bogle proved that doing less, buying the market and holding, quietly beats those who overthink it. Ayao would have smiled at this. He believed real markets reward patience and cooperation, not frantic guessing. The lazy investor doesn't fight the system. They flow with it. But what's the machine they're really trusting? What makes this lazy idea so powerful that it rewrote how the world invests? The answer begins with the silent engine behind it all: the ETF. What exactly is an ETF? The term sounds complicated, but it's simpler than most people think. An ETF, or exchange-traded fund, is like a basket of investments that you can buy with a single click. Inside that basket could be 500 companies like the S&P 500, or a group of energy firms, tech stocks, or even global markets. When you buy one ETF, you own a slice of everything in it. Think about it this way. Instead of betting on one company to succeed, you bet on the entire team. In 1993, the first ETF, called SPDRS and P500 SPY, launched quietly. Few cared at first. Yet today, SPY alone manages over $500 billion. And ETFs worldwide now control more than $10 trillion. That's the size of Japan's entire economy, just sitting in funds that don't need human managers shouting at screens. ETFs trade on stock exchanges like normal shares, which means you can buy or sell them anytime during the day. But unlike mutual funds, they don't have hidden sales fees or surprise tax bills at year-end. Every expense is upfront. Every holding is transparent. That's why investors, especially younger ones, are shifting fast. By 2024, 65% of U.S. investors under 35 used ETFs as their main investment tool. The power is in how they work. Most ETFs simply mirror an index. If Apple, Microsoft, or Amazon grow, your ETF rises with them. If one company crashes, the others soften the blow. That's diversification, your safety net in a risky world. John Bogle's idea of owning the whole market through index investing became real through ETFs. They turned complexity into simplicity and emotions into math. But simplicity creates its own mystery. If it's so easy to grow wealth this way, why do traders still fail to match the returns of people who do nothing? The answer lies in how patience beats prediction, and how compounding turns quiet investors into millionaires. The power of compounding. Without the headache, small actions create massive outcomes when time gets involved. A person investing $500 a month in an S&P 500 ETF since 1990 would now have over $1.6 million. That's without picking a single stock, making a single trade, or checking charts every morning. The secret is compounding, the quiet force that turns patience into profit. The math feels unreal at first. 10% yearly growth may not sound exciting. But when gains start earning gains, the growth curve bends upward like a rocket. Albert Einstein called it the eighth wonder of the world. Ayao would have said it's the purest proof that value grows best when left alone. Every reinvested dividend, every year held, multiplies effort without lifting a finger. But compounding cuts both ways. Someone who waits 10 years to start investing must save twice as much each month to end with the same wealth. Time becomes the most valuable currency of all. Therefore, the lazy investor isn't lazy. They simply understand how to let time carry the load. Real investors like Warren Buffett embody this principle. Nearly 99% of Buffett's wealth came after his 50th birthday, not because his strategy changed, but because compounding finally took over. The lesson is simple. Consistency beats brilliance. Market crashes, recessions, or wars interrupt progress temporarily, but compounding resumes quietly in the background. Every recovery since 1929 has proven that staying invested works better than trying to outsmart volatility. So the power isn't in trading, it's in holding. The ETF investor uses time as leverage instead of luck. But if patience builds wealth, why do professionals keep trying to outguess the system and lose every time? The next chapter reveals how constant motion became the costliest mistake in modern finance. Why active traders keep losing. Every market cycle creates a new wave of confidence. Traders think they've cracked the code until the numbers tell another story. Over a 15-year period, more than 85% of active fund managers underperform the S&P 500. The few who do beat it rarely repeat the feat. That means the smartest minds on Wall Street lose to a plain ETF that never blinks. The problem hides in behavior. When prices rise, greed takes over. When they fall, fear drives selling. The average investor underperforms their own investments by about 4 percentage points a year because they buy high and sell low. In 2008, many investors bailed out when the market dropped 40%. Those who stayed in doubled their wealth within 5 years. Emotion costs more than any management fee ever could. Trading also burns money quietly through costs. Every buy and sell triggers taxes, spreads, and commissions. Studies from Dalbar Research show that the typical investor's return over 30 years is around 4%, while the market gives closer to 10%. The gap is made of impatience. Even hedge funds, built on speed and data, face the same wall. In 2023, the average hedge fund returned just 6.4%, while the S&P 500 did over 15%. Algorithms trade billions, yet a passive fund quietly wins without effort. The market rewards discipline, not motion. ETFs explained this decades ago. When incentives twist, signals blur. Active traders chase noise because they think value comes from movement. But wealth grows from cooperation with time, not competition with others. The lesson is clear. The calm investor outlives the clever one. But how can someone build that calm into their money plan and still grow faster than inflation? The answer lies in simple habits that turn ordinary paychecks into lasting wealth. Building wealth the simple way. Wealth often feels like a puzzle built for geniuses, but the truth is far simpler. The people who win with money are the ones who follow a few steady rules for a very long time. No drama, no predictions, just process. The first rule is consistency. Putting money in regularly, no matter what the headlines say, beats waiting for the perfect time. That's the idea behind dollar-cost averaging, investing the same amount each month. When prices fall, your money buys more shares. When prices rise, you already own them. Between 2008 and 2020, anyone who kept investing through the crash tripled their wealth by the time the market recovered. Fear punished those who ran. Patience rewarded those who stayed. The second rule is low cost. Every extra fee cuts into future gains. For example, a 1% yearly fee may not sound dangerous, but over 40 years it eats almost 25% of your total return. ETFs change that game. Some charge as little as 0.03%, which means nearly every dollar you earn stays yours. Then comes diversification. It's what protects your portfolio when chaos hits. In 2022, tech stocks crashed over 30%, but investors who held ETFs across sectors, energy, healthcare, finance, still came out positive. They didn't need to predict, they just spread the risk. Markets move in cycles, but discipline keeps compounding steady. Every small contribution builds ownership, and every dividend reinvested adds another layer of growth. ETFs' philosophy fits perfectly here. Prosperity grows where cooperation and patience replace speculation. Wealth doesn't come from chasing peaks. It comes from letting time do its work. The final step, though, goes beyond numbers. Because wealth isn't just about returns, it's about freedom. The next story uncovers how real investors stop chasing fortune and start building lives that money can't control. The real secret: freedom over fortune. Every investor starts by chasing money. Then, somewhere along the way, the goal changes. Wealth becomes less about the number in your account and more about what that number allows you to do. Freedom. That's the real finish line. The quiet truth is that markets reward patience, but freedom rewards discipline. Owning ETFs gives you both. You own pieces of thousands of companies at once: Apple, Coca-Cola, Nvidia, even the small factories that make the parts no one talks about. Each one works for you while you sleep. It's capitalism compressed into one click. In 2024, more than $11 trillion sat inside ETFs globally. That's larger than the entire GDP of Japan. Why? Because ordinary investors finally realized they didn't need to guess to win. When you buy an ETF tracking the S&P 500, you're trusting in the productivity of the world, not the predictions of a few. Ayo always said capital must stay free to find its best use. ETFs are that idea in real form. They move capital where it's most efficient, to growing companies, to industries that create value. No middlemen charging 2% to manage your future. Just ownership shared across millions. However, the magic only works if you let time do its job. The moment you try to outsmart the system, you cut off compounding. Real wealth grows in silence. It doesn't shout, it builds slowly, year after year. Therefore, the lazy investor isn't lazy at all. They're the ones playing the long game while everyone else chases noise. They buy freedom, not stress. And that's the greatest secret of all. Wealth is quiet, patient, and always working in the background, long after everyone else gives up chasing it. Thanks for watching till the end. If you love stories that turn simple ideas into real wealth, subscribe and join the next one on screen.